What if I told you there is a company that lost nearly $425 million last year?
That is a staggering amount of money to lose.
Right. I mean, they make practically nothing in revenue. They are just burning through cash at this alarming rate.
Just setting it on fire, basically.
Exactly. But, and here's the part that is going to sound completely made up. Wall Street analysts are currently calling it a strong buy.
Which just sounds backwards.
It does. They are valuing this thing at almost $1 billion. So today we are doing a deep dive into a stock that makes traditional math look, well, completely broken.
Yeah, it really defies all the standard logic.
So imagine you're looking at a stock that is down massively from its 52-week high, right? On paper, it looks like an absolute disaster.
A total falling knife.
But right at this very moment, it is riding a 40% surge in just 5 days.
That's serious short-term momentum.
So the big question for you listening today is this. Are we looking at an undiscovered, undervalued gem that's about to make a specific type of investor very rich? Or, is this just the ultimate retail value trap designed to break your heart and your portfolio?
Honestly, it's the ultimate market paradox right now.
Yeah.
We have this chart that screams caution on a historical level, but then a short-term momentum profile that screams massive opportunity.
So welcome to today's deep dive. We are putting a company called Strive Inc. trading under the ticker symbol ASST under the microscope.
Right.
And we've got the real-time data as of today, April 17th, 2026. We've got the charts, the analyst ratings, and we are going to tear this whole financial architecture apart to figure out what is actually going on beneath the surface.
And before we get into the weeds here, I do want to establish a firm baseline for you listening.
Always important.
Yeah, while we are examining real-time market data, technical charts, and analyst price targets, this entire discussion is strictly an intellectual exploration of market mechanics.
Right.
This is absolutely not financial advice.
But we are not telling anyone what to buy.
Exactly. We are just here to decode the psychology, the corporate maneuvers, and the underlying math driving this particular stock, not to tell you what to do with your brokerage account.
Perfect. So let's set the stage for this mystery. Yesterday, April 16th, Strive closed at $13.98.
Okay.
It was up 3.33% intraday, which shows some serious short-term bullish momentum. But to understand this wild ride, we really have to look at the company's radical identity crisis.
Because it is radical. They are completely changing who they are.
Yeah, Strive is undergoing this massive foundational strategic transformation. Like, they used to be a social media marketing firm.
Right, a traditional software and services play.
But following a recent merger, they are just completely abandoning that path to become a publicly traded Bitcoin treasury and asset management entity.
In a complete paradigm shift. I mean, you are taking a traditional service-based software business and retrofitting it into a holding company for a highly volatile digital asset.
Which is wild.
It is. That is the kind of aggressive pivot that gives traditional value investors severe anxiety.
I mean, it's like, okay, imagine walking into a failing bakery that only sells like $6 of bread a day.
Okay, I like this analogy.
But the owner is asking you to invest $1 million because he is clearing out the ovens to install a high-frequency trading server.
Right.
You aren't buying the bakery's cash flow anymore. You are funding the owner's new, highly speculative gamble.
That analogy captures the valuation mismatch perfectly. But to fully understand how jarring this transition is, we really have to correct a massive illusion currently sitting on their stock chart.
Oh, you mean the 52-week range?
Yes, because it is incredibly wide. It shows a low of $7.02 and a staggering high of $268.40.
And when you look at that, a drop from $268 down to $13, that looks like a total unmitigated collapse.
It looks terrifying.
It looks like a company going to zero.
It does, but that $268 high is actually a mathematical phantom.
Wait, what do you mean by phantom?
It's heavily skewed by a 1-for-20 reverse stock split that happened earlier this year.
Okay.
And the company doesn't just execute a 1-for-20 reverse split because things are going well.
No, definitely not.
They do it because their stock price has fallen so low that the exchange is threatening to kick them off. It's basically a survival tactic to artificially inflate the share price and maintain listing compliance.
So they basically just mashed 20 low-price shares into one high-price share just to stay on the exchange.
Exactly.
Yeah.
The underlying value of the company didn't change at all, just the window dressing.
But the danger there is that, like, algorithmic trading bots scan those historical highs, right?
Yes, bots and uninformed retail traders.
Right. Someone sees that 268 Euler mark on a chart and thinks, oh, wow, I'm buying a towering giant at a massive discount.
which is completely false.
Yeah.
The previous high wasn't some golden era of profitability. It was mathematical life support during a very messy transition.
So that massive drop just reflects the market aggressively resetting the company's value as they dumped the old social media business.
Precisely. Which means we really can't look at the historical chart to predict the future.
Right, the past is irrelevant here.
We have to look at the immediate data to see the new narrative taking hold. And that new narrative is reflected in that 29.15% gain over the last month.
So the old investors, the people who wanted the bakery, to use my analogy, they've sold out, they're gone.
Long gone. That recent nearly 30% monthly gain shows that the new Bitcoin treasury strategy is starting to attract an entirely different species of investor.
Okay, but hold on. I'm looking at these financial numbers from the actual balance sheet, and my head is spinning.
Yeah, the fundamentals are rough.
If I'm a listener looking at this, the transition reveals a super jarring mismatch. Their trailing 12 months revenue is practically microscopic for a public company.
It's what, around 5 million?
Just $5.73 million. Now, sure, that's up 57.1% year over year, but it's still peanuts.
It is literally a rounding error for Wall Street.
And the losses are brutal. Net income is sitting at negative $424.91 million. Yeah. Earnings per share is deeply negative at negative $28.36, which is primarily due to all these merger and restructuring costs.
Right. Tearing down the old business is expensive.
And the cash flow is hemorrhaging. Free cash flow sits at negative $132.47 million.
So they are burning cash at an astonishing pace.
Exactly. Yet their total cash on hand is only $67.5 million.
Okay.
So how on earth is the market valuing this company at a market cap of nearly $1 billion?
It's a great question.
Specifically, $967.5 million. The price-to-sales ratio is a sky-high 86.77x. Enterprise value sits at $1.03 billion. How does $6 million in revenue plus $67 million in the bank equal $1 billion valuation?
Well, it's because the market is entirely ignoring that historical $6 million in software revenue.
They just don't care.
They do not care about the social media marketing past at all. That $967.5 million market cap reflects purely speculative value based on what the company plans to do next.
Okay, so what is the plan anchoring that value?
The valuation is anchored to two things. First, there's $67.5 million in liquid cash, which is now explicitly meant for Bitcoin accumulation.
Right.
And second, and this is much more important, their stated commitment to raise and deploy up to $1.5 billion in capital for their new Bitcoin strategy.
Wait, I have to challenge that mechanism.
Go for it.
How does a company with negative $132 million in free cash flow, burning money every quarter, suddenly convince anyone to hand them $1.5 billion?
It's a massive ask.
Traditional banks aren't going to underwrite $1 billion loan for a company with those metrics.
You're right. They won't use traditional banks. They are attempting to replicate the playbook popularized by companies like MicroStrategy.
Okay, so how does that work?
They will likely issue convertible senior notes or dilute existing shareholders through massive equity offerings.
Ah, I see.
They are essentially selling debt to institutional investors' debt that can eventually be converted into company stock and using that cash to buy Bitcoin.
So the buyers of those notes are essentially betting on the underlying Bitcoin price, using the company's corporate structure as a proxy wrapper.
Exactly. Investors are saying, judge us not on the software money we've lost, but on the $1.5 billion of Bitcoin we are planning to hoard.
Wow. So you aren't buying a marketing firm anymore. You are buying a leveraged bet on digital assets.
Yes. Investors are buying AST stock because they believe management will successfully execute that massive capital raise, buy the Bitcoin, and ride the broader crypto wave.
Okay, so since traditional fundamental analysis like PE ratios and cash flow are basically useless here, we can't use standard math to evaluate this stock.
No, standard math will just tell you it's bankrupt.
Right, so we have to look at the actual footprint of the money flowing in and out. And that brings us directly to the technicals and market sentiment.
Let's get into the charts.
Where are the buyers and sellers actually drawing their lines in the sand?
Well, the technical chart shows a strong support base at the $7.02 low and a secondary floor at $9.
Sure.
That $9 mark is crucial. If it breaks below that, The current bullish thesis is in serious trouble.
And on the upside, immediate resistance like the ceiling it needs to break through is at $14.28.
Which, interestingly, some valuation models actually estimate as its current fair value.
And if it breaks that $14.28 ceiling, the next heavy resistance sits at $19.74.
Those support and resistance lines are the structural battlegrounds right now.
The momentum indicators flashing on this chart are fascinating too. Like, while the stock is still below its 200-day simple moving average, it just showed a bullish crossover on the 20-day simple moving average.
That's a strong short-term signal.
Yeah. And for you listening who maybe doesn't stare at trading terminals all day, we also see the RSI and MACD turning positive.
Maybe we should define those real quick.
Good call. So the RSI, or Relative Strength Index, essentially measures the speed of price changes to tell us if a stock is overbought or oversold.
Right.
And MACD tracks the relationship between two moving averages to identify momentum shifts. Both of those are flashing green right now.
And they're doing it on high volume, which is key, because volume is the lie detector of the stock market.
I love that phrase, lie detector.
It's true. A bullish crossover on low volume can just be a head fake orchestrated by a few large trades.
Yeah, easy to manipulate.
But an average of about 3.43 million shares trading daily means institutional money and heavy retail interest are actively flowing into this new narrative.
Oh, and this is a huge but. The sentiment data reveals a massive contradiction.
Oh, it really does.
We have two completely opposing forces at war here. On one side, we have insider bold moves. Executive stock purchases were reported back in February 2026.
So the people running the company were buying their own stock.
Exactly. And just 2 days ago, on April 15th, the SATA preferred dividend was increased to 13.00%.
See, that 13% figure is incredibly aggressive.
Really? Why?
Because a preferred dividend sits above common stock in the payout hierarchy. Offering a 13% yield is basically a distress level incentive.
Wow, okay.
It tells us management is desperate to attract and retain capital, which aligns perfectly with that heavy cash burn we discussed earlier. They are paying a massive premium to buy time.
So they're paying 13% just to keep capital in the building, and insiders are buying. But then, on the other side of the battlefield, short interest is sitting at a staggeringly high 19.65%.
Almost 20%.
Nearly a fifth of the traded shares are currently sold short.
That is a massive institutional bet against the company's survival.
Right. So if the insiders were buying, and they are bribing investors with a 13% dividend, why is a fifth of the market betting against it?
Because short sellers look at that negative $132 million in cash flow and assume the company will fail to raise the $1.5 billion it needs.
They just don't believe the story.
Exactly. They believe the Bitcoin pivot is a desperate, doomed gimmick.
This sets up the potential for a really violent market reaction. I want to break down how a high short interest interacts with positive momentum at the actual brokerage level because it's fascinating.
It's the mechanics of a squeeze.
Right. So when a hedge fund shorts a stock, they borrow shares from a broker, sell them into the market, and hope the price drops so they can buy them back cheaper later, pocketing the difference.
But if the price goes up instead, their position starts bleeding cash, and they are paying borrowing fees on those shares every single day.
And eventually, if the price climbs high enough, the broker issues a margin call.
Which is the terrifying part for a short seller.
Exactly. They force the short seller to close their position to prevent further losses. But to close a short position, you physically have to buy the stock back at whatever the current market price is.
So combine that 19.65% short interest with the positive technical momentum we just outlined. The 20-day crossover, the high volume, the green MACD.
It's a powder keg.
It is the structural blueprint for a short squeeze.
Yeah.
If the company announces a successful debt offering, or if they successfully execute a large Bitcoin purchase, the stock price spikes.
And the short sellers are suddenly trapped.
Yes, the brokers auto-liquidate their positions, smashing the buy at market button.
And all that forced, panicked buying acts like rocket fuel, driving the price up exponentially higher in a matter of days or even hours.
Right. The short sellers actually become the primary catalyst for the very rally they were betting against.
It creates this self-fulfilling upward spiral that completely decouples the stock price from any rational fundamental valuation.
Exactly.
So with all this extreme volatility, the heavy short interest, and the fundamental corporate restructuring from, failing software to speculative crypto, We have to debate the ultimate question for you, the listener.
The big question.
Is AST truly an undervalued asset right now, positioned for a massive squeeze, or is it a classic value trap for retail traders?
Let's look at the analyst consensus.
Yeah, let's analyze it. Across 4 major reports, the consensus rating is a moderate buy.
Okay.
That breaks down to 2 strong buys, 1 buy, 1 hold, and 1 sell. The average price target is $19.33, which represents about a 38% upside from current levels.
And the high target is $26, which was just initiated by TD Cowen on April 10th.
Which is huge.
Those are incredibly optimistic targets for an entity with such severe operating losses.
Right. TD Cowen says it could hit $26, but I have to play devil's advocate for the retail trader who might be getting caught up in the hype here.
Please do.
Retail traders notoriously get trapped in these transition narratives. They see a 40% 5-day surge, they read the word Bitcoin in a press release, and they jump in via their trading apps.
Fear of missing out. FOMO.
Exactly. But if Bitcoin dips by even 15%, or if credit markets tighten and they can't actually raise that $1.5 billion, doesn't this entire billion-dollar valuation collapse like a house of cards?
It absolutely could.
Doesn't the retail trader just become the exit liquidity for institutional insiders?
That is the paramount risk, and you've outlined the bear case perfectly. Because the divergence between success and failure here is absolute. There is no middle ground.
So let's trace both scenarios to their logical conclusions.
Okay, let's start with the bull case, the recovery and squeeze scenario.
Yeah.
This relies on flawless execution of their capital strategy.
Everything has to go right.
Yes. The short-term technical outlook is undeniably strong. If management successfully issues those convertible notes, secures the $1.5 billion, and begins aggressive Bitcoin accumulation while the broader crypto market remains favorable.
That's a lot of ifs.
It is, but if it happens, that high short interest triggers. The forced buying blasts the price right through that immediate $14.28 resistance, shatters the $19.74 level, and rapidly hits that 26-tile TD Cowen target.
Wow.
In that specific scenario, AST is a brilliant leveraged play that utilizes structural market mechanics to generate massive returns.
That is the dream scenario where the early believers get heavily rewarded. But what is the nightmare? What's the bear case?
The bear case is the continuation lower. The long-term outlook here is exceptionally fragile. Like you said, you cannot wish away $132 million in negative free cash flow.
No, math always catches up.
Right. If Bitcoin stumbles, the value of their treasury drops, making their corporate debt increasingly toxic.
And if that happens?
If institutional lenders refuse to fund their $1.5 billion capital raise, the entire narrative dies overnight.
Just poof, gone.
Gone. The momentum evaporates, the short sellers double down, and the stock crashes right back through the $9 support, hitting its $7.02 floor and potentially spiraling even lower toward delisting.
So in that scenario, it was a classic value trap.
Exactly. Retail investors who bought the hype get left holding a depreciating asset, while the institutional money and short sellers profit from the collapse.
So when you step back and look at this entire picture, Strive Inc. is a fascinating, almost unprecedented case study in modern market mechanics.
It really is.
We are watching a company shed its old skin entirely in real time. It is leaving behind an ugly, money-losing software balance sheet to tie its entire future and a nearly billion-dollar valuation to the wild, unpredictable ride of Bitcoin accumulation.
It's a battleground stock.
Yeah. Where insider confidence, aggressive 13% dividends, and bullish technical indicators are colliding head-on with massive cash burn and heavy short selling.
It is the purest distillation of risk versus reward in the current market environment. You are placing a bet on a management team's ability to execute a high-wire corporate metamorphosis.
While simultaneously navigating the most volatile asset class on the planet.
Exactly.
As a final reminder for everyone listening, analyzing these charts, discussing these price targets, and breaking down the mechanics of a short squeeze is an educational exercise in understanding how modern markets function.
Yes.
It is not an instruction to buy or sell AST or any other security.
Knowledge is about understanding the topography of the landscape, right? Not blindly following a treasure map drawn by a biased analyst.
Very well said.
But I want to leave you with a final provocative thought to ponder as you watch companies like this evolve over the next few years.
Okay, let's hear it.
We discussed the bakery earlier, the one that stops baking bread to hoard gold. If a company's entire value shifts away from what it physically produces or the services it provides to society and becomes entirely dependent on what it holds in a digital wallet, are you even investing in a business anymore?
Oh, wow.
Or are you just buying access to a highly volatile, publicly traded vault Think about what that shift means for the very definition of a corporation and the long-term future of the stock market itself.
A publicly traded Volt. Suddenly, analyzing a balance sheet isn't about revenue streams and profit margins, it's about tracking digital wallets and debt leverage.
That's a whole new world.
The diagnostic landscape of a company's true value has never been murkier. Keep your eyes open, and we'll see you on the next deep dive.